This is a line graph charting the price of Bitcoin in US dollars between 2015 and 2023. It maps out a highly volatile market environment where sudden, vertical price spikes are routinely followed by steep, rapid crashes. In traditional finance, the stock market moves at the steady, regulated pace of a passenger train. The crypto market behaves like a fast, unpredictable roller coaster. The appeal of this volatile system comes down to its core mechanism. Cryptocurrency is digital money that exists entirely on the internet. It is controlled by technology rather than a central bank, allowing anyone to send funds globally without needing an institution's permission. The architecture supporting this network is built on dense, highly complex mathematics designed to be completely secure and practically unhackable. Yet that secure mathematical foundation sits in sharp contrast to the daily reality for many users. The headlines are filled with overnight market crashes, stolen funds, and compromised accounts drained to zero. To understand why this space remains so wild, we have to look at the massive gap between the flawless code it runs on and the highly vulnerable humans who use it. Every cryptocurrency relies on a foundational piece of technology called the blockchain. This diagram illustrates how the network operates as a decentralized public ledger. Data is stored simultaneously across thousands of computers worldwide. Because every node constantly verifies the data, once a transaction is locked in, no individual can secretly alter it. Different types of digital assets use this secure network in distinct ways. Assets like Bitcoin function primarily as a store of value. They act as digital gold, designed specifically for users looking to hold wealth over long periods. This market heat map breaks down the ecosystem by asset type. While Bitcoin holds the largest share, networks like Ethereum function as platforms to run decentralized applications. Meanwhile, assets like Tether are stablecoins, designed to keep their value permanently pegged to the US dollar. The base layer provides a perfectly structured, unchangeable accounting system, but the individual assets traded on top of it serve vastly different, largely unregulated purposes. The absolute security of the blockchain ends the moment we introduce the human entry points, crypto exchanges. This image displays a typical Binance exchange interface, which operates as a digital stock market. Here, prices are dictated entirely by supply and demand, with rapid swings driven by news cycles, online hype, and the sudden moves of massive investors known as whales. The primary vulnerability emerges when users leave their digital money resting directly on these platforms or inside online hot wallet phone apps. By keeping the funds connected to the internet, they expose their assets to cyber attacks and simple human error. This graphic illustrates a common scam known as a rug pull. This occurs when malicious developers build up intense hype for a new coin to attract eager investors, only to abruptly abandon the project and drain the invested funds. When millions of dollars disappear overnight, the underlying mathematical blockchain hasn't failed. It is almost exclusively the human infrastructure built around it that fractures. The extreme market swings and the proliferation of scams are direct byproducts of decentralization. Eliminating the bank as a middleman also eliminates the safety net. Without a central authority in charge, there is no customer service number to call to reverse a fraudulent transaction or to refund a hacked account. This environment gave rise to the foundational rule of digital assets: not your keys, not your crypto. The only way to guarantee true ownership and protect against online theft is to use a cold wallet. These are offline, physical hardware devices that secure your private passwords entirely away from any internet connection. As this diagram outlines, long-term investing relies on the steady growth of a firmly planted tree, whereas short-term trading resembles haggling over goods in a volatile daily market. Surviving the crypto space requires adopting the mindset of the patient investor. Practical risk management relies on a few strict parameters, starting with small amounts of capital, deliberately avoiding hype-driven alternative coins, and holding only foundational networks. Participating in a bankless, global economy provides a level of financial freedom completely detached from traditional borders. However, that total sovereignty requires accepting absolute personal responsibility for every digital cent.